Hi, welcome back to Economics Made Simple. In this video, we're going to explore interest rates and why they play such a powerful role in the economy. Interest rates are essentially the cost of borrowing money. When individuals or businesses borrow money from a bank or financial institution, they must repay the original amount plus interest. The interest rate determines how much extra must be repaid. Interest rates affect many areas of the economy, including spending, investment, savings, and housing markets. In most modern economies, interest rates are influenced by central banks. A central bank is responsible for managing a country's monetary policy. Monetary policy refers to the actions taken by central banks to influence economic activity, often by adjusting interest rates. When interest rates are low, borrowing becomes cheaper. This encourages households to take out loans and spend more money. Businesses may also borrow more in order to invest in new equipment, expand production, or hire additional workers. When interest rates rise, borrowing becomes more expensive. This tends to reduce spending and investment across the economy. Let's look at a simple real-world example. Imagine a family considering buying a home. If mortgage interest rates are low, the monthly cost of borrowing money to buy a house is relatively affordable. More people may decide to buy homes. This increases demand in the housing market. However, if interest rates rise significantly, mortgage payments become more expensive. Some families may decide that they can no longer afford to buy a home. Others may postpone their purchase. As a result, demand in the housing market may fall. This example shows how interest rates influence major spending decisions throughout the economy. Central banks often adjust interest rates in order to control inflation and stabilize the economy. If inflation is rising too quickly, central banks may increase interest rates to slow borrowing and spending. If the economy weakens, they may lower interest rates to encourage more spending and investment. So to summarize, interest rates represent the cost of borrowing money. They influence spending, saving, and investment decisions. And central banks use interest rates as a key tool of monetary policy to help stabilize the economy. In the next video, we'll look at government debt and why governments borrow money.